Welcome to Grow Money Business, the podcast dedicated to helping business owners optimize income, pay less in tax, and invest prudently. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the show, my guest is Ray Drew. Ray is a managing SBA business development officer at FundX Solutions and specializes in, you guessed it, SBA-backed financing. So if you are someone who's trying to go out there and borrow money to buy a building for your business, or maybe buy a business or expand or do something and you need to borrow money, you should probably listen to this episode because Ray's program and the SBA in general might be a really good avenue for you. Ray's been in the space for a long time. He's a lot of fun to talk to. He walks us through the genesis of the Small Business Administration itself. He goes through the ins and outs of the 7A program, and there have been some substantial changes to the 7A program after the PPP, Economic Injury Disaster Loans, that came out last year that he walks us through. So he knows a whole lot about this stuff. He's a lot of fun to talk to, and I hope you enjoy the episode as well. Hey everyone, I need to interject quickly to remind you all that nothing found in today's episode or any other episode of Grow Money Business should be considered financial, investing, legal, tax, fitness, or even relationship advice. It's content that you're free to use and to deploy on your own terms. And before taking any actions on content found on the show, please do consult with your tax professional, your attorney, or your financial planner. If you don't have a financial planner, head on over to threeoakswealth.com to learn more about what we do in terms of financial planning and investments and how we help clients on an ongoing basis. There we go. Welcome, Ray. Happy to have you on the show today, my friend.
Happy to be here.
So SBA lending is something that I get a fair amount of questions about in our financial planning practice about as potentially a mechanism for funding. There are a lot of rumors. I think a lot of people, at least that I speak with, just don't have a very good perception or a very clear perception of what it actually is. So I'm really excited to maybe learn from you and have you explain some of this, some of these dark arts to us. So why don't we start with this, Ray? Could you tell us a little bit about what you do on a day-to-day basis, what your role is, and then maybe we can dive in from there?
Yeah, absolutely. The rumors, some are true, some are not. I remember when I started in SBA lending 13 years ago, I was basically in a sales role where I was coming out of college, just learning SBA, which is there's a steep learning curve, right? And so I was on the phone all day with small business owners all around the country. Now, this is 2011. So the idea of getting a loan from the internet, basically, because we were a nationwide lender based in Orlando, was a little foreign. And the SBA was a little foreign because you got the information from your banker. You didn't really have this, right? People can't just tune into this and listen. So there was way more crazy stuff back then. So my days back then were really educating folks, small business owners and aspiring small business owners on the benefits and clearing up the misconceptions and demystifying the whole thing. And a lot of that's continued today. So now 13 years later, I'm managing business development officer at FundX Solutions Group. We're a national non-bank SBA 7A lender. And we could talk a little bit about what that means later, non-bank. But my days are fielding calls from small business owners, a lot of them trying to buy businesses in this market, and some buying real estate for their business, and then guiding them through the process all the way to the closing table where we lend them the money and then they hopefully pay us back over 10 to 25 years. And that plus managing my team and then doing stuff like this, just educating the marketplace on all the benefits. Because I wouldn't be doing this for 13 years if I wasn't a firm believer in the product.
So what is? Why don't we walk through the genesis? Where did the SBA come from? The Small Business Administration backed loans. Where did it start?
Yeah, I want to say Dwight Eisenhower, if I have my history correct. But the SBA was created in the 1950s. And ultimately, it's there's a lot of aspects to the SBA. The loans are a big part of it, SBA loans. And under that umbrella, there's a ton of options. But the main one that everyone talks about, the flagship, is the 7A. So when you think about, I'm going to go get an SBA loan, that's what we're talking about. It goes up to $5 million and you can use it for start a business, buy a business, expand your business. It's actually a really flexible program in that regards. And this is a job creation program at its heart. So one of the first misconceptions, to clear up is the SBA doesn't lend the money, right? The SBA provides a guarantee to banks, credit unions, and the non-bank lenders that if the loan goes bad, then they'll bail them out for about 75% of the potential loss. And what that allows these lenders like myself to do is make loans we wouldn't have otherwise made, thereby helping create and retain jobs in communities, as well as provide terms that we wouldn't have otherwise offered. Longer repayment schedules so the monthly payments are more affordable. Lower equity requirements so that the capital can be accessible to more people. And just the flexibility overall with the underwriting, how we structure it, and the lack of loan covenants, which is really nice. It just adds a little bit of certainty to the equation, because in conventional financing, if you fall below a certain debt service coverage ratio that I'm sure most people aren't like sitting there every day as a business owner calculating themselves, they can call your loan. And that's a situation you don't want to get into. And with SBA, you don't have to worry about it. You just make your payments and you move on. So the SBA is a public-private partnership, essentially, that allows banks to make loans to small businesses. And it's probably one of the only things working out of Washington these days. And it's basically an insurance policy that banks get to be able to make really good loans with really good terms to businesses.
I have heard some banking friends describe the 7A program and other SBA-backed vehicles as, if I'm a Joe business owner and I want to go buy maybe a competitor or like a piece of real estate for my business to operate in, and I walk into the bank. You mentioned that the program enables lenders like yourself to be able to put loans out there that you wouldn't otherwise make, right? Make loans that you wouldn't otherwise make. And I've heard other bankers describe these as if you come in with a really sound financial condition and you ask to borrow money, you might be better off skipping the SBA-backed financing entirely and just going with whatever the bank can give you, because since the SBA is guaranteeing the loan, and they have a lot of checks, boxes to be checked and hoops that the lenders jump through, and it's a little bit more onerous for them for an underwriting standpoint. How accurate is that? Can you give me some color on what that actually looks like?
Yeah, all right, we're going to get into misconception number 2 here. So you're going to hear a lot of things. First of all, you go into your bank for an SBA loan, chances are you're not going to the right place for the right thing. The SBA market is so diverse. It is not a cookie cutter program whatsoever. The guarantee is like silly putty that the SBA gives to all these different lenders. Was there over 4,000 bank charters, and about a quarter of them are active in the program, and about 30% of those are actually specializing in SBA. So we're really talking about 150 really active SBA lenders, some lending locally, some nationally, and some regionally. And out of that pool, we're all doing different things. We're all structuring the loans a little different. I might do 100% financing for real estate. This bank might think that's crazy and only want to go 90. I may do this deal that got declined by 10 other banks, and I may require certain things that other lenders don't require. It is a crapshoot. And so that's why it gets a little confusing if you're a first-time borrower going into this market trying to say, hey, I just need to finance this project for my small business, whether it's maybe buy a building and expand. And where do I go? Where do I start? And that's why educating yourself is like the most important thing you can do. But then also work with an expert, because if you go into your bank and they're not one of the, let's call it 150, first of all, it's going to be a painful process. If you're not specialized in it, have a dedicated department working on it. I mean, we have 45 people here at Fundex that are just doing SBA all day. So we're like the ultimate specialist, right? We only do one thing. But no, I mean, if you're not one of those banks, you're probably not going to you're going to say what it's really like at your bank, which is, hey, this is going to be hard. This is going to be painful. We don't really know what we're doing because we don't do this and specialize in it. And that's going to be true for them. But first of all, depending on what you want to do, the SBA, chances are it's definitely a product you want to take a look at least, even if you can get conventional, because the terms are going to be different. They may not be better. There's people that if you're buying a building, and this is one of the biggest things we do is we finance commercial real estate. So if you're a business and you don't care if you put down 20%, 30%, 40%, you just want the best rate. Your business is mature, it's stable. You just want to buy a building with a good rate, a good long-term fixed rate. The 7A program is probably not the best for that business. Now, I don't talk to a lot of, maybe you do, but I don't talk to a lot of businesses that have unlimited cash. The ones I talk to, they're trying to preserve their capital. So the ones who are really watching their cash and reinvesting their dollars into growing their business, and they're seeing good growth, and they want to now buy the building, but they don't want to have to choose between, do I put this $200,000 into the real estate, or do I put it into growing my business? With the 7A, you don't have to choose. If you work with the right lender, we do 100% financing for real estate. And then we'll even say, hey, let's give you some more capital on top because this building's a little bigger than what you're used to. And you're going to want to buy new equipment to fill that space. And you're going to need more inventory to put through the equipment. And we're going to need to hire 2, additional employees. And we're going to be able to, under the 7A, which no other program will do this, put together that entire financing package for you and put it on a 25-year repayment schedule, which is, best in class.
So why might, can you help me understand how different lenders are able to offer those different terms? Why might one lender be interested in putting a package together like that, whereas another lender wouldn't?
Every lender starts with designing their own credit box. The SBA gives you some guardrails that you have to stay within, but that's only 50% of the equation. The rest is the lender designing what they want to do, what they're comfortable with, what their appetite is, and that's just going to vary lender to lender.
Makes total sense. Now, you mentioned when we were just getting started here before we hit record that there's been a lot of changes here. What, 12, was it last year or was it earlier than that when all the changes hit? It was 2023. So walk us through the climate beforehand. We were in an interesting lending environment there in 2020 through 2022 as well, with the economic injury disaster lending and the Paycheck Protection Program and all that too. What was the landscape beforehand and what are the new changes?
Yeah, the economy, the last couple of years prior to COVID, the economy was doing really, really good. I mean, I literally, coming into the business in 2011, going all the way through COVID, I just thought that the economy just goes up every year. I didn't know it would go down, I'm like half kidding, but like every year we just saw incremental growth. And those last couple, we were just red hot. And the rates were still at that time relatively low. I mean, these rates for SBA are based on prime. We were dishing out rates at, right before COVID, around 7.5%. There was a 6-year period from 2010 to like 15-ish where the rates just stood at what we called 0% interest rates. In SBA, that meant around 5-6%. And so even when the economy got red hot, we were only up to 7.5%. And these are business loans, right? These aren't mortgages. So the rates are always going to be a little higher. It's not like residential. So when COVID came, the word of the year was PPP, right? A lot of regular lending just shut down and we went full force into PPP. Then during this period of the last few years, you just saw thing after thing. I mean, you had rates jump up. Rates are double now. We're doing rates 10, 11% for SBA loans. You had the supply chain crisis in there. You had inflation in there. We had SBA giving out incentives at one point. Now, this is last year, after all that happens, the SBA comes out and says, hey, we're going to change all the rules now. And they just swept through with just massive changes to their beloved 7A program. And some are good and some are bad. But during all that in the backdrop, I just want to mention like business acquisition started going insane. So in a good way. You saw this trend with baby boomers retiring and how a lot of them own businesses. And And then the rise of really on podcasting and social media, the discussion around this got a lot of people that are seeing like these sellers sell that the kids don't want to take over the businesses. These are boring businesses, sweaty businesses, HVAC businesses, these types of trades, manufacturing, you name it. And all of a sudden, all people from all over the place, whether you're exiting corporate America, you got laid off from tech, you're, a private equity refugee, like these people just wanted to come in and buy businesses. And the SBA is really the only game in town to do that, because you buy a business for $3 million, there's no collateral. And most conventional lenders won't even touch that. So the SBA is how those deals get done. And so you're seeing the rise of that. And then in 2023, some of the big changes they made were just opening up the valve. They just made it more flexible to do these things by changing equity requirements and opening the door to partial change of ownership. So those were two of the big changes.
Interesting. So walk me through partial change of ownership.
So prior to this past year, the only option was, I'm going to buy 100% of this business. The seller's going to go down to zero. They're going to stay on for a period of up to 12 months to transition the business. They're not going to be an employee. They're going to be like an independent consultant. They're just transitioning, and then they're out of there. And, there's pros and cons to that, right? Maybe you want that because you want the employees to know you're in charge now, right? They don't want you, if you keep the seller around for 3 years and now you're in some sort of partnership, who's actually in charge? There's sometimes some confusion. And then also, it's like you're having to work with the seller. You might have ideas for their business and they might be emotionally attached to the way they were doing things. So that's just, I want to paint both sides. So, that's a potential area of concern if the seller is going to stay on post-close. Now, for continuity purposes, we like having a seller stay on post-close. If they retain 10%, let's say, they're incentivized to make this successful, because down the road, if the new owner does a good job and sells the business 5-10 years down the road, the seller, the original owner, is going to be able to benefit from that second bite at the apple, we call it, because they're going to sell and hopefully more value is created and they're going to ultimately get more for their business. Now, they open the door to that, basically, where I can come in and buy 90% of a business, 99% of a business, 80% of a business, whatever. The only caveat there is, and this is just blanket, anyone who owns 20% or more of the business, borrowing the money, personally guarantees the loan. That is normal in small business lending. But when you're a seller selling the business, exiting, getting a bunch of cash, and then maybe hanging around with a 10%, equity incentive, you're not going to guarantee the loan. So that's why most of these are being done where the seller drops below 20. This partial change of ownership also helps with licensing transition now, because the seller's able to stay on long-term post-close. And on some of these situations where the licensing is a little tricky, take some time to transfer, it's kind of helps there. So it's not, I don't see it being like a massive shift, like every deal is going to be partial change, but it certainly gives us now the flexibility in many scenarios that we just didn't have. And that's a good thing.
Yeah, absolutely. I mean, that's most often what we see. And we work mostly with business owners in our practice. A lot of them are going through these transitions and transactions, both into and out of. And that's when you look at the most successful exits, those that are successful for the seller, where they get everything that they want out of the deal and are able to preserve jobs and all the stakeholders are taken care of and they get enough money out of it after tax. And the person purchasing that stake is happy too, and the business is, remains an ongoing viable interest. That's typically how it works. Is there some gradual transition? I was unaware of the 20% threshold for the personal guarantee. And so you're saying that after the changes, anybody with more than a 20% stake in the business has to personally guarantee the loan. Did I understand that right?
That's correct, but that's always been the case. That's not
that's
didn't
not
change.
A change. That's always been the case. Okay, gotcha.
Yeah. In fact,
so what else is?
I was going to say, in fact, because this is the part that not everyone has the stomach for a personal guarantee. Now, if you're in small business, most of these are personal guarantee. Like the only folks I know of that are somewhat not used to a personal guarantee is like some real estate stuff where it's non-recourse debt. But in the world of small business, like you're all in. And so that's normal with all sorts of small business loans. But what the SBA goes a step further. And this is something where it's just like, this is probably where I get the most pushback, is the SBA requires lenders to pledge all available collateral. So most of these deals are unsecured or undersecured. And what the SBA says is, before we put our guarantee here and put the taxpayers at risk, make sure that the guarantors, so anyone who owns 20% or more, pledges all available collateral. And what that means is if they own any real estate, so you wholly own a piece of real estate, even if it's your house, and it has equity in it, and the cutoff is 25% or more equity. So if you have lower leverage on your house, essentially, the SBA wants you to take that equity and pledge it towards the loan until all your collateral has been pledged or the loan is fully secured, whichever comes first. So that's another part of SBA lending that people should know about.
Sounds pretty scary when I hear you describe it, but realistically, if you're in that position, you're probably used to doing that kind of thing anyway. I mean, you're kind of risking the house going out on a limb and maintaining an organization in this manner. It's really not that big of a jump for most people.
Well, people understand, like everyone understands that at this point when they come in, it's one of the first things you learn about SBA, but it's not, it doesn't, you don't see that and say, oh, well, I'm not going to buy this business now because I don't want a second lien on my house. Well, you're buying a business because the business is making $1 million a year to the bottom line, and you're able to buy it for 3.5 times that number, which is a multiple 3.5 times earnings, just to throw out a number that you're not going to see anywhere else in the markets, right? And so it's like, okay, if you're just not comfortable, you're just not comfortable. Now, there might be 1 or 2 deals a year where a spouse doesn't want to do that, right? And so the deal dies. And so that's why we'd rather just lay it all at the table up front. Because having a second lien on your home and that threat is uncomfortable for some, but as a small business owner, you're all in, right? That's the thing. That's why small business owners are so special. It's high risk, high reward type of deal. So.
Absolutely. So what other changes went through last year?
So the big one is the equity. So again, business acquisition is booming. And with business acquisitions, that's really the only type of project where the SBA mandates a specific equity injection at minimum. So if I'm buying real estate or I'm buying equipment or I'm refinancing debt or getting working capital, the SBA basically says, you as the lender, Ray, you can decide if an equity injection is necessary, and if so, how much. But when it comes to a change of ownership transaction, so business acquisition, the SBA does have a say, and they say we need the buyer to put in equity. And for the last many years, it's been 10%. So that number has stayed. So the minimum equity injection, if you're buying a business, 10%. Okay, now what can make up that 10%? That's what changed. Here's the answer. And this is kind of this kind of actually was shocking to a lot of people. The SBA came in and said the seller can give it to you in the form of a seller note. The entire thing, all they have to do is not accept payments for 24 months. And then after the 24 months, you pay them back over X amount of years, 5, 10, 7, whatever. So no balloon, just a fully amortizing term. And then that will count that as your equity. And when we said, oh, okay, so a lot of people are going to hear that and say, so I could buy a business with no money down, right? That's where a lot of the internet likes to go with that. The answer is yes, you can, technically and theoretically, if a bank is willing to do that. Now, I'm willing to do that in very limited circumstances because I believe, and we believe in buyers having skin in the game. It's a phrase that's been around for decades for a reason. And the times where I think that we can actually allow that high of leverage where it's literally you're bringing no cash to the table is two instances for me. I'm just speaking for me and for us. One is if you've been running the business. If you're a manager in a business for 5-10 years, building it up for the owner, taking on responsibilities, and you have the chance because your owner is retiring to take over that business, I think those are awesome transactions. And I'll do those all day long because you have sweat equity, right? And if the seller, all your money is from the seller anyway, they pay you. And historically what would happen is the seller would give them some sort of bonus, and then they would give it right back to the seller at closing as their down payment. And it's like, why are we even doing this? So they've allowed that flexibility, which I love because it's going to allow so many employees, aspiring entrepreneurs to buy the business they've been running. In fact, I did one of these where we didn't have that sort of flexibility. They had to bring in some of their own cash before the changes, and it was 5%, which is fine. They had it. They scraped it together, but they had it. But it was someone who was essentially a receptionist at a salon, worked her way up to stylist, went to beauty school, manager, and then CEO, owning the business essentially because of the SBA loan program that we were able to help her with. And so stuff like that is like what it's all about, right? Just having regular employees work their way up, learn the business inside and out, and then ultimately own that business. I think those are great.
That's very cool. That's very cool. So 10% down is the minimum in any business acquisition, but you can structure it through a seller's note to make up that 10%. That didn't used to be the case. Many lenders might not be comfortable with that, except in limited circumstances. Now, from your position, you're in business development. You're going out trying to find these deals and close deals and close loans for the benefit of the borrowers. When you're going through that process, you take the information, you hand it to the credit department, and they're making the ultimate decision, I suspect. Do you have skin in the game yourself when one of these things goes sideways? I've always been curious how that works from someone in your role.
Well, that's a good question. So I'm what we call a BDO, a business development officer. The name came from this shop. I think it came from the shop in the 90s called the Money Store. And this was one of the first non-bank lenders to really just crush it in our space. And they essentially revolutionized our industry because really before they came in, this program was the redheaded stepchild at the bank, right? Everyone tried to avoid it because it was complex. And they said, well, why not just do this conventional? I don't want to mess with the SBA. And so the Money Store got one of these non-bank licenses, just like we have today. And they said, we're actually going to go to market with the SBA program. And where they ramped up, they had 100 BDOs all around the country. They did $1 billion a year, which I still think is the most impressive ever, even in today's market, where there's a bank that does over $1 billion, but the cap back then was 2 million. Now it's 5. And back then you did business a whole different way. So what they did was incredible. And when that shop got sold, and then essentially it didn't go, I don't think that acquisition went well. I actually don't know exactly what happened, but pretty much it got sold and then it was the end of it. But all those people spread out, and then they went and did other non-bank lenders, GE Capital, CIT, and all of a sudden it was BDOs, the BDO model. That's what took over the industry. So that's what we do today. And so I know a lot of my friends are BDOs, and good ones are like me, where it's like we are credit officers in the field. So then there's some that like to throw everything up against the wall to see what sticks, right? But if you work with a good person, which I encourage, they're going to act as an advisor and they're going to analyze risk. And we don't get to approve anything, but we are going to analyze it. I say no more than I say yes. And ultimately, we're going to package it up in a way where here's what's wrong with it. Here's why it still makes sense. Credit officer, I want to propose that we do this loan. I just want to make sure I get your buy-in up front, right? Because you're ultimately going to be the final decision maker. So I act in that capacity, right? I am putting myself in their shoes and trying to go out there and find good loans for us, and then working with everyone to make sure that we all understand the information and make the right decision. And if a deal does go bad early, yeah, I have some skin in the game.
So tell me about Fundex being a non-bank lender. You're finding these deals, you're sourcing them, you're advising clients, working with them to structure these things, packaging them up, taking to a credit officer at a bank somewhere. And what is that relationship like? How does that
No,
work?
it's internally here at Fundex. We have
Okay.
a credit manager, we have a chief credit officer.
Okay.
Credit manager signs off up to $2 million. We're lending our own money.
Oh, you are? Okay.
Yeah, credit managers signing off deals. Chief credit officer is signing off on deals, and we have a committee that handles loan requests between 3 and 5 million. And the loan committee is actually more of a modern loan committee. It's one of my pet peeves about shops and banks is they still do old school credit committee, and they meet only every Thursday. Sometimes you have to go through multiple credit committees if it reaches a certain threshold, and it's, the boardroom, and you're talking about it, and you have all these people on the committee talking about your loan request that you've never met and will never meet. And that's super old school. Now, banks do it fine. We don't. We just write it up. Because we know what we're doing. We're searching for a specific type of client. So we have sort of a box that we like to play in. Now, there's sometimes that where it's outside the box, but there's a mitigant to balance it out. So we put all that stuff out on the forefront. And when we have a deal ready to get voted on by committee, we push it out to them electronically. They all read it. There's like 4 people on it. And then they provide their feedback. So it meets on demand, right? So we're set up for speed. And that kind of goes into the whole non-bank culture. And when we started and went to market at the beginning of 2020, that was our thing. We wanted to go to the market for speed and execution, right? So we are set up in that way so that we can try to run circles around banks. And it helps when your sole focus is just doing one thing and being a specialist in it and doing that every day and having every employee at the company just doing that one thing. It just gives you the ability to learn faster and then move faster. And that's what we've done. And we've built a great reputation in the space.
Very cool. So can you help me understand what a non-bank lender is then? What does that specifically mean?
Well, it's a non-bank institution, so everyone's a little different. It just means you're not a bank. Now, for us specifically, we're wholly owned by a company called BHG Financial, and they are a sort of a fintechy company that has been around for 20 years. They really got famous by doing really fast working capital loans for doctors, like $250,000 or so. And they've expanded and they've actually sold part of the company to a bank, Pinnacle Bank. So their holding company owns actually 49% of our parent company. So that's one example where essentially we're 51% owned by just people with equity, right? And a lot of people do it with that way without having any sort of bank ownership, and they fund off warehouse lines for the most part. We actually don't. We lend our own money, which is one of our secret weapons, really, because that's it's what drew me here 3 years ago. It's like, I've never seen that before. You're usually kind of going off warehouse lines and then you're limited to what the warehouse lenders will let you do. But here we can do what we want to do because it's our money.
So you're not taking deposits. And by warehouse lines, what does that mean?
A warehouse line would be like when a lender borrows money to lend it out.
Okay.
So it's, that's the model of non-bank lenders. And that goes across multiple industries. They're just, So for us, we have cash on the balance sheet and we're lending out. Oh, no, we don't do deposits, which is nice because, who wants to move their whole banking relationship, which a lot of SBA lenders require if they do your deal. And that's kind of a pain. It's just one less thing you have to worry about. And the other thing is we work with a lot of banks. Look, there's a lot of banks out there. And when somebody's trying to buy a business, even with the 150 banks that are active in SBA, the majority of them are just not going to touch a $2, $3, $4, $5 million deal with no collateral. Even though the SBA doesn't necessarily care about collateral, banks do. And so we are cash flow focused. We're really collateral neutral. We just follow the SBA's guidelines. But, if the only problem is it doesn't have collateral, I'm sure we'll still do that because everything else makes sense. But that is not how most SBA lenders see it. Most SBA lenders just get a little squeamish after a certain threshold for whatever reason. But we partner with those banks to get those deals done, and we're not a threat to their banking relationship. So they get to keep, because if they just let them go out into the market, then they might find a bank that's going to require them to move that bank relationship over. So we help protect against that.
Right. Okay. So another topic I wanted to touch on with you is commercial real estate landscape. You mentioned that the equity requirements are lower. Did I hear 100% financing for those deals for like an owner occupied business? Yeah. And has that? So I'm curious. I'm curious what the difference is from your perspective of an existing business buying the building in which it's going to operate and an acquisition with a 10% equity requirement. And I'm also interested in the landscape right now and what your credit department thinks, because a whole lot of people are pretty bearish on commercial real estate in general.
Well, from the small business owner standpoint, you're going to look at these things a little differently because one, to answer your question about equity, you have to have equity. Businesses need equity. You either have equity or you need to bring equity. There's going to be equity somewhere. So when I'm doing commercial real estate financing, I'm starting with an operating business and I'm looking at the balance sheet. And I'm going to see that business owner has built up equity in their business. Now they're buying a building, which is essentially an asset for your business. It's a home for your business. So I'm going to say, there's the equity. This business has equity, sufficient, invested equity. And so we don't need them to bring in more equity. They've put in the equity to buy their building. If you're buying a business, you don't have that. You've got to bring in the fresh equity because you got to start with some equity. Now, if you're coming to me to buy a building and you don't have equity, your balance sheet's upside down, you'll need to bring in equity. Right? We don't want to get reckless. So now the other thing you said is, on commercial real estate being bearish. Look, I'm very bullish on a small business buying their real estate because if you need a location, you're probably renting. It's a couple things. Certainty. Owning your own place gives you some certainty. Now, there's some businesses where it doesn't make sense to own your real estate. That's the minority, in my opinion, because you might need to move and expand, and you want more flexibility if you're growing and stuff like that. But ultimately, that building becomes the cornerstone of your retirement for many business owners. Because if you're going to own your business for the next 20 years, you got a couple options. You can pay rent and make your landlord rich, or you can make yourself rich. And if you are building up equity instead of paying rent over 20 years, you're going to be left with an appreciating asset that is worth money that you can then sell, or sell your business and keep the building and become a landlord. You've got all that flexibility. And I just think it is a really powerful tool for small business owners that want to create equity and create wealth for themselves.
Yeah, I agree on pretty much all that. I've seen this work out really, really successfully for, probably half a dozen of our clients. You own it for either you buy or you build yourself. You own it for a decade or more, and then what better setup than to sell your business and remain the landlord in the building? Because you're going to know the tenant better than they know themselves at that point. It's just a wonderful thing that works very, very smoothly. I have seen it go sideways a couple of times when the business acquisition or business exits don't wind up the way that you hope that they will. Then all of a sudden you've got to find a new tenant if things really go sideways on you. And there's risk like anything, but if you're paying rent, you may as well be paying it to yourself.
Right.
So if you're in a situation where you want to borrow some money, and let's say it could be for a real estate acquisition or an expansion or a business purchase, what are some things that you can do to improve your terms on loans? Just real basic what should you be thinking about?
You should be thinking about paying your taxes. So the SBA is a cash flow focused program where we're going to analyze your historical financials. Now, if you're a startup, we don't have historical financials to look at. Startup lending is harder. Startup franchise lending is robust, but independent startups, a little harder. Possible, but we're going to be looking for a lot more strength. Now, most of the deals I do are existing businesses. I'm getting 3 years of tax returns plus the interim financial statements. So year to dates. Your last tax return is super important to the loan decision. It's going to allow you to borrow and get more leverage and get better terms, possibly. So think about that when you're doing your taxes at the end of the year, because there's a few different schools of thought when it comes to tax planning. And if you are showing no profit, you're not getting a loan. That I'll just leave it at that. So make sure you're, paying close attention to how you're doing your books and your taxes, because you want to set yourself up to be able to get the capital you need to, expand your business and ultimately create more value in the business. So you got to kind of think about the bigger picture and the long game when it comes to that tax planning stuff.
So is there any consideration for like deferrals into qualified retirement plans like 401ks? That's like a low-hanging fruit as far as tax planning goes that we talk about and help people with all the time. If I make $100,000 in profits and I have the opportunity to defer 50 of it into my profit sharing plan, is a lender going to look at only the 50 remaining, or are they going to consider the 50 that I just chose to defer but had the opportunity to take out as cash flow and pay tax on?
Well, first of all, we're talking if you're an existing business versus an acquisition. So an acquisition, that's going to be very clear cut, right? That's a owner benefit. We add that back. So if you're buying a business, or if you own a business that you think you might sell in the next few years, I wouldn't not say don't do that. Do that. If that's what your advisors are telling you to do, you'll be fine. I'm talking more about writing off all of your meals and all your travel and all your personal expense and all this stuff beyond. I'm not a tax expert. I'm just saying that when we are underwriting your loan requests, we are looking at the cash flow that you are reporting on your tax returns, and that is one of the biggest pieces that we look at in terms of deciding how much financing you'll qualify for.
Right on. That makes sense. Ray, this has been awesome. You have a lot of wisdom in this space, and I really appreciate you spending some time with me going through all these things I've been ruminating on and have been asked about over the last several years. Where can people find you if they need to borrow money?
Yeah, the easiest thing to do is just go to sbaray.com, and you can also check me out on YouTube. Just type in SBA Ray.
SBA Ray, I like it. Right on. Well, thanks again. I appreciate you spending the time, and we'll have to have you back on again soon.
Yeah, I enjoyed it. Thank you so much.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners optimize income, pay less in tax, and invest prudently. Be sure to subscribe to the podcast on iTunes, Google, Spotify, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements, and feel free to submit questions to growmoneybusiness.com.